Hi everyone, I'm Rosemarie Miller here with serial entrepreneur, angel investor, and a former media executive, Jim Sherman, here to tell us all about how early stage startups can not only survive a VC funding drought, but thrive. Thank you so much for joining me today, Jim.
Thank you, Rosemary. Thanks so much.
So, Jim, why is there a VC funding drought? Let's start there.
Oh, as you can imagine, the markets that when they're going up, they're going down. We've always seen periods where there's a strong fervor for investing, particularly in high-risk investments in the venture community, and we've seen lows. I mean, a lot of it is tied to the fact that the IPO market has been a bit shaky. A number of IPOs that were not stellar, or they came out of the gate and then fumbled. That causes problems. We're in a high interest rate environment. There's a bit of uncertainty regarding the economy's stability. So a lot of this is giving pause to investors in terms of whether they want to bet, which, by the way, is the riskiest of all types of investments, on brand new startups. So the venture community, I believe, is running about at least a third behind where they were last year, maybe even a half. And it's at all stages. The early stages hit as well as the growth stage of financing.
And so how should startups navigate these challenges?
If you're just getting going, and of course you're looking to raise funds, I mean, I think one of the big challenges is going to be trying to validate demand as cheap as you can. I mean, because investors at the end of the day, if they want to minimize the risk, then they're going to want to understand, what have you done to validate that there's actually really interest in your idea? So I think that's something we really, and we talk about it in our book, but the validation of demand is crucial, especially in a tough funding climate. The way you do that is, first and foremost, focus on the front end, okay, the user interaction on the front end, and keep the operations simple and cheap. All you want to do is have as minimal set of features as possible to validate that your users or customers have interest in the product. And I can give you a couple examples if you'd like.
Yeah.
So, for example, with Rent the Runway, I'm sure you're familiar with them. Maybe you've used them before.
Yes.
So for the rental of dresses, they're a very sophisticated site. But in order to get going, believe it or not, they got going without having a fully functioning website. They had racks of clothing that they put up with pop-up stores across college campuses. They went to about 5 or 6 pop-up stores, and they made the designer dresses available for women to rent for special occasions, and they merely wanted to validate that women were interested in this. And I was really surprised with the creativity that Jen and Jenny had, the founders, had in doing this to validate demand. I thought was fascinating. And they actually videotaped the interactions of the customers as they were buying these dresses to demonstrate not just that they liked the service, but that they loved it. They were passionate about it. And they later used the videotaping of those customer interactions to help them close deals with venture capitalists. So that was a very creative way of going about raising the financing and spending very little money to validate demand early on.
Yeah, I was talking to someone a few days ago at Under 30, and they mentioned the people who invested in them, they didn't invest in their company. Apparently, they thought the company was a horrible idea, but they invested in the person. How normal is that?
It is normal because with the earliest stage in particular, there are 3 things that form the trifecta, I think, for investors, whether it's an angel investor or a venture capitalist. I mean, they're looking at any traction to date. That's important. Do you have the traction, some demonstration of proof points? They're looking at the founder, no doubt about it, the value of the founder team. I mean, that's key.
What do you mean, value of the founder team?
Well, does the founder have relevant skills for the venture? That's critical. Relevant skills, not necessarily industry expertise, because that's different. And sometimes we talk about this in the book, actually. If people that are in an industry are the least likely to disintermediate it. They're the least likely to come up with creative solutions of new products. It often takes someone coming from outside the industry. But you do need to have relevant skills to execute on your idea. So the investor is looking at is there a large opportunity here? That's key. Is there a large opportunity? Do you have any traction to date? And then do you have the relevant skills as a founder or the founding team to execute on it, to pull it off. So that's really, really crucial. That's what I think maybe you've been hearing in terms of founder fit for a venture. An idea is only a 20% of the solution, right? You need to have a great idea, but you have to execute on it.
Well, Jim, let's say I wanted to start a business tomorrow. I have my little pitch deck, all of it set up. Like, give me step by step. How do I make this a reality and not just some dream?
I mean, I think that the first thing is if you have to make sure that you yourself have evaluated what we call this ideation triangle, and assessing that you believe, let's assume you do believe that it is a large opportunity, okay, that the large opportunity is there, that you have relevant skills to pull it off, and clearly you're going to have the passion to create this new venture. But in terms of raising funds, the first thing I would say is, first of all, does the venture need to be venture-backed? A lot of times, there are many wonderful businesses that can be bootstrapped and can be pushed along to become very nice businesses that don't require venture capital backing. So, for example, Josh Hicks of Plated, who we interviewed, Josh points out that there are many wonderful businesses that can become $50 million a year businesses in e-commerce, but those don't warrant venture capital backing. They're not investable businesses. So one should, you should first reflect on, do you need venture capital? Now, assuming you do, then you should bootstrap as long as you can. And there are many advantages to bootstrapping the business. One is that you are going to take smaller steps, which means if you make a mistake, you lose less. It's very important that in the beginning you're taking small steps to see what works and what doesn't work. Second, you can iterate faster because there's smaller steps. You iterate quickly, you get feedback and iterate, make improvements. And thirdly, the lack of resources, the lack of a lot of cash forces you to be more creative and finding not just a way forward, but the best way forward. And that's really crucial in the early days. That's what's going to give you a long-term advantage if you can figure that out. But yeah, no, I mean, you want to try to prove as much as you can of interest in the product or service before going out to raise formal financing.
Okay.
And then we can talk about that in terms of those steps if you're ready to go out and raise the money.
Before we get there, I want to take it back, actually.
Okay.
Before I even decide to do this, how do I know it's the right time to quit my 9-to-5 and become an entrepreneur?
Oh, well, that's okay. So that's certainly a really good question. And when we look at the profile of founders, there are a few things that stand out. One is you do have to have this passion to create. That is absolutely essential. You just have to have that passion. And you need to really have the relevant, you're coming up with an idea, of course, but you need to know the right time to jump. And knowing the right time to jump is going to be a function of a number of things. What is your personal financial situation? Do you have like a backup? Do you have money in the bank in case things go wrong? Where are you in life personally? Are you married or not? Do you have kids? What's the family situation? And what is just your own risk profile? Fundamentally, it's how big an appetite do you have for it? Because the people that jump, admittedly, have more of an appetite than the ones that don't. So I think that for your case here, as you're describing it to me, I would say that you have to really understand whether or not you're ready in life, with where you are in life, and do you have an idea that you think is worth pursuing, where it's worth taking that risk.
Okay.
Yeah, it's a tough call, and I think this is what ultimately prevents entrepreneurs from becoming entrepreneurs is they haven't figured out the right time to jump.
And how many no's should one be able to withstand before they realize, okay, maybe I don't have a good idea, or should I keep the faith? Should I keep tweaking and going and tweaking and going?
I mean, one of the problems is if you're not fully invested in it, it won't be a success. So it's very hard to do it on the side.
Okay.
It is hard. I think there has to come a point where you, the entrepreneur, are saying that you're ready to go for it. You need to go for it. And that's where the risk taker in you is going to say it's worth the risk. But admittedly, look, I mean, if I look back at some of the founders that we spoke to, many of them had come out of business school at Harvard Business School. So they had just graduated. They weren't necessarily putting a lot at risk. They were early in their careers. They could go off and attempt to build a startup. And if it didn't work, they could go back and get a corporate job. So that was that's the way some of them looked at it. We talked to others who had been out for a number of years, but they didn't have kids yet. We looked at a married couple. They didn't have children yet. They thought it was a good time to take the plunge.
Truly, what's the power of a business degree these days? Is an MBA or something, is that even worth it?
I mean, I think that it is worth it if it has a good entrepreneurship program. I mean, certainly in our book, we're focusing on the HBS founders and what they may have learned. We talk about actually what they may have learned in school, but we emphasize in the book what they learned the hard way, or what it was unconventional lessons, things that they may not have learned in school. So I think that there's an academic study of entrepreneurship that makes sense, and it helps, I think will help to improve your odds of success. But there's a lot that people learn on the job. One of our founders, it was Anna Auerbach of Work, and she had said, there's no Lonely Planet guide to entrepreneurship. Mm-hmm. There is no guide. You're just out there. And at the end of the day, you're going to learn by doing it. You're going to learn the most by doing it. So actually the purpose of the book has been to try to improve the odds of success, because actually it's more than 70% of seeded startups will fail. Believe it or not, over 70% will fail, and only 10% have any measure of success. So it's tough. It's tough odds, and I think that getting an MBA, if there's a strong entrepreneurship program, is helpful in learning the foundational elements and frameworks and studying various cases. But at the end of the day, I think also learning from people that have been there, done that, and have real world stories, I think that's very valuable.
So aside from getting a business degree, how can one improve the odds of success for their startup?
I think one way of doing it would be ensure that you start early on in building out an advisory network. If you can have a little kitchen cabinet of advisors, at least maybe one, two, or three people that have been entrepreneurs themselves. Maybe one of them has industry experience in the industry you want to go into. Another might have a finance background. Try to shape a bit of an advisory board that could be your informal advisors as you get going. I think that can be very helpful, because being an entrepreneur is often a lonely endeavor. It just is. And so I think if you have mentors that could be by your side, that's very helpful. Of course, you can also bring on a co-founder, right? That's a big question mark for a lot of people. Should they or shouldn't they have a co-founder? You may have several co-founders. And we found that any combination works, by the way.
Really?
Yeah, I mean, there's a bit of a myth that you need to have let's say a CEO and a CTO, or a CEO, CTO, and CMO. I mean, that there's a bit of a myth on the 2-person or 3-person team, but what we found in our research is that any and all combinations work. We saw a mother and son combination, we saw a husband and wife, we saw 2-person teams, 3-person, 5 people, some of whom were junior co-founders. So it really just depends on your personal preference. Do you want to share the journey? I think if you're a first-time founder, it makes a lot of sense to try to share that journey so that you can manage the roller coaster ride here together.
And how do you choose the exact person you should be sharing that journey with?
It's tough, right? That is tough. I mean, we saw in our interviews, there were several combinations of founders that met while they were in school, so they became friends. Some were friends even before business school. Some met through happenstance, or what we call forced serendipity, just being out there and meeting people at various social events or meetups. So I think that you have to try to make it happen in terms of putting yourself out there. And I think that there will be these co-founder relationships are either through friends or someone from your past, maybe someone from work, or like I said, it's through forced serendipity, putting yourself out there and getting the word out that you're looking for a co-founder. We saw that with Dave Parker of Yumble Kids, and he happened to mention at a Sabbath lunch he was in need of a co-founder to help them in operations for his business, which is a fresh meal service for kids. And somebody at the table happened to know someone that had been at HelloFresh, a meal kit company. So that's how he ended up bringing on board a junior co-founder. So you just have to be out there talking about your startup a lot.
Okay.
And maybe word will get around. And, if you want to make it happen, you'll find a way to make it happen, to bring on a co-founder. But we also heard from Herman Morgan Wake of Adore Me, who built a very successful company in women's lingerie, which he sold to Victoria's Secret for $400 million. And he was a solo founder. And he was adamant about saying he didn't need a co-founder. He didn't want to waste time in making decisions. He didn't want to have to vet that with somebody else. He didn't need to share the emotional roller coaster. He thought he had enough support through family and friends and others. And he made the point that, it's a big dilution hit as well when you bring on a co-founder. Immediately you have a 50% dilution if they're an equal co-founder.
Well, Jim, I want to know, what are some of the top challenges you see entrepreneurs face and how they overcome them?
Oh, the top challenges for entrepreneurs, certainly it's going to depend on the stage of their development, right? And we go from the early ignition phase, the foundation phase, ignition phase, scaling up, financing, and ultimately exiting. And the fact is there are challenges at each of these phases. I think the biggest challenges are you able to really get to product market fit? Can you validate the demand in a cheap enough way to entice then investors to come in and support you on it? Because the financing is your rocket fuel that you need. So you need to try to allay those risks as best you can. And we see a lot of, probably one of the biggest risk factors is people think they have product market fit, but they don't. And it's what we call, you need to have feedback that is not just good, but great. You need feedback that blows you away. Good feedback is not good enough. That's actually the name of one of our chapters. And a lot of founders, they want to hear great things about their startup. They want great feedback for it, but it may not be great. And as one example with Matt Salzberg, before he started Blue Apron, he had a science crowdfunding site called Petri Dish, and the feedback was okay. It was doing all right. But he eventually moved on and launched Blue Apron, and the feedback, he said, was so qualitatively, the magnitude was so different. He had people writing into Blue Apron saying, "You saved my marriage." The steak recipe you had was out of this world. I can't thank you enough.
I'm going to stop you right there. How do you know when to pivot?
Well, this is the point to reflect on whether you pivot.
Okay.
Yeah, you're hitting on it right now, because that's the key point. If you're not getting feedback that blows you away, then you need to pivot. You need to either figure out how you're iterating the product further to refine it. Can you refine it to get massively good feedback? Or if you cannot, then you need to move on. You have to, and it's a tough decision. And by the way, sometimes that's when having a co-founder is a good thing, because sometimes it's the co-founder relationship where together you can make what is emotionally a very hard decision. So for example, Bespoke Post, we interview the founders there, and Steve and his co-founder Rishi, they originally started off with a QR code reader that you would scan QR codes when you're in a store, and it would tell you about sale items for that product, and it just wasn't working. It's just they realized that it wasn't taking off. They didn't have a background in tech themselves. They weren't feeling it. The feedback wasn't great, and they knew they had to pivot. But it was a painful decision. And Steve readily admits that if he didn't have a co-founder, he might not have made that decision to pivot to their men's e-commerce venture that they got into instead, called Bespoke Post, and that zoomed up like a rocket ship, and it's super successful today. So sometimes you have to be just willing to accept the feedback if it's not great and make changes, which can mean starting over. Sometimes the pivots are more minor and more tactical if it's in your growth stage and you need to tweak your marketing or you need to change how you're handling operations. Those are different kinds of pivots, less radical ones. But you always have to be able to anticipate when your business model is under stress. So that's also another key challenge for founders, is to anticipate, or otherwise they're going to fail. They have to anticipate what's coming, otherwise they're going to fail in their business.
So what advice do you have? Because I've been talking to quite a few people over the last few days, the CEO of Fearless Fund, Clio Capital. What advice do you have for minorities or people who are just struggling? They're in that group where they're only getting like 2% or less of the funding. How do they go out and find money for their businesses?
Okay. Well, I would say some of the same things that I would say to anyone in general looking, but I'll underline it more in the case of minority or women seeking funding. First off is you have to start early and seek warm introductions to venture capitalists or angel investors. And it's a lot of hard work, but you need to seek out those that may have good contacts that can make a warm introduction to those parties. Doing cold call outreach can work, but it's definitely harder. So that's number one that I would focus on. The second is that you do have to have a good method of communication. You have to lead with what will impress people. And whether you're a minority, a female, or whomever, if you've got something to impress them with, then lead with that. And whether that's in an email or in your pitch deck, you need to try to convince them to take that meeting with you. And how you present is going to be crucial. So practice on your presentation skills. It's the charismatic leader. You read the stories about the Steve Jobs of the world. People like that. Even Adam Newman of WeWork, who was a master at this as well, in being able to inspire the potential investors with their vision. And so that's something that's crucial. In the case of finding the right targets to talk to, we talk about doing your homework and the importance of trying to target your outreach to the right VCs that have an interest in your industry, in your stage of development, in the check size that you may be looking for. And by the way, I would add, there are many that are looking to invest in minority-owned businesses. So try to target those that have a strong interest in that. It really is worth one's time to focus in on hitting the right targets, because it is a bit of a numbers game, but it will behoove you to zero in on the targets that are the ones most likely to have an interest in who you are and what you're doing.
Well, Jim, before I let you go, is there anything on your radar that you believe should be on ours?
As an investor, or in terms of starting up something?
In entrepreneurship, startups.
Obviously there's a lot of buzz these days with AI, and everyone does look at this as a platform revolution in the way that the smartphone was, in the way the internet was, internet 1.0, and what that produced. And I do believe that AI is going to be changing most existing businesses, and it's going to offer huge new opportunities for whoever comes up with great new ideas around that. So I think that certainly should be on everyone's radar. It's hugely important. I think that in terms of other areas of opportunity, I would just say, with our interviews of 18 Harvard Business School founders, none of them were science-based, by the way. They're all business model innovations. And you can just look around you in your life and what's going on. And if you can find some way to solve a problem in what is a large market, if you solve a problem in a large market, you're going to have then a very nice large opportunity of a business. So I encourage folks to just think about what's going on in your life or in the life of your friends or family, and where is there an area where you think you can improve something. Because you have to ask yourself, where do good ideas come from? Well, many of them, in fact, a majority of them, come from things that happen in one's life. Could be at your work, could be in your family life, or something that happens to a friend. And it's part of it is keeping your antenna up and keeping your eyes and ears open for where there may be opportunities. I'm convinced that the entrepreneurs out there that end up jumping in and doing it are the ones that have their antenna raised, that are seeking it out.
Thank you so much for joining me today.
Okay. Thank you so much, Rosemary.